my name's Bill Kovalchuk, and I'm president and co-founder of Claret Asset Management. This is part 2 of our series on how accounting, investing, and disclosure have had to change to keep up with the times. These days, the way accounting is used says a lot. Let's look at 2 examples. We will begin with a simple accounting example. Cash on the balance sheet used to be just that, cash. But today, that requires a footnote. Cash may be held offshore in a subsidiary and subject to tax if it is repatriated. Think of Apple as an example. So $100 on the balance sheet may only give you $70 after tax, depending on the tax rate. The impact then is that companies would rather borrow money domestically to pay a dividend rather than repatriate the cash and pay tax. In the future, that available cash will likely be used to grow the company outside of its domestic tax jurisdiction. Cash may be required for implicit or explicit reasons, such as for regulatory purposes, bonding, or capital requirements, and therefore it is not accessible. An extreme example can be found in 227 Chinese companies with a market value of more than $100 million US that have more cash on the balance sheet than the market value of their entire company. Any logical investor would simply buy the company, remove all the cash to make a profit, and have a free operating company. But that cash is not available to the investing shareholder. It is not cash as we used to know it. Next, let's look at the example of intangible assets. It is a more complicated but important topic. Coca-Cola has spent a tremendous amount of money in advertising over the years. That spending shows up as an expense every year on the income statement, but there's no presentation on the balance sheet of an asset. Yet if another company were to purchase Coca-Cola in its entirety, the price they would pay would be dramatically more than the book value of the company today. The difference in the price would be called an intangible asset or goodwill. More complicated examples are patents or intellectual property in the tech and biotech sectors. Please join us for part 3 in this series, where we discuss Claret's approach to value investing.